Are we going to have a recession? Is inflation going to infinity? Stagflation? There's so many voices out there saying so many things, but how do you figure out the good takes from the bad? What happens if everybody's wrong? Here's my take. I think that economic growth is going to fall sharply at the second half of the year, sharper than people expect. And maybe that changes the equation for the Fed. I think inflation is going to ease off quite sharply too. But I've been in markets long enough to know that we all get it completely wrong sometimes, and I could be dead wrong. So if you're looking at this slowdown that I'm also picking up in my indicators, it's not clear outside of the yield curve. There's only a few things that have got recession kind of written all over them. So it's not consistent yet as far as I can see. But it feels to me that we're at the tipping point where the inflation pressures start coming off and the year-on-year rate of change starts going down, and we start to see ISM slow down heading towards 50. And that looks like it's the next kind of 3 to 4 months we start seeing that.
Exactly.
What happens to the market? Because I think the market fundamentally has changed because of the reaction function from central banks. So historically we had, a recession would lead to a 50% drawdown that lasted 18 months or so. But it feels like the currency debasement side of stimulus and monetary policy changes that. How are you thinking through all of that? Others would say, well, the Fed aren't going to stimulate anytime soon, but I kind of think the market's forward looking.
And I totally agree with you on your cyclical outlook that cycle's coming down. There's a couple of things that look recessionary. Some things don't quite yet. I do think over the next 2 to 3 months, we could get there depending on how some of the things that you mentioned play out. We can go into that a little bit more. But as far as the market, the $1 million, trillion question is the Fed's reaction function, right? Because we know the cycle is going to slow. The forward-looking indicators are saying that with a pretty high degree of confidence. But is the Fed going to pivot, right? Are we going to have a December 2018 event, and is the Fed going to pivot? This time it's different, right? Because inflation's quite high. They say that they're not going to pivot until inflation comes down. I think that we have a huge gap. As you mentioned, we are at one of these inflection points, because what I see right now, Raoul, is the bond market that's pricing in another 8 hikes. The Federal Reserve is saying we're going to do another 7 hikes, but the equity market is not saying 8 hikes, right? So there's a huge disconnect between what's being priced into the bond market, what the Fed is saying they're going to do, and what the equity market is saying. And some of these divergences you can pick up in some of the internals of the equity market. I mentioned utilities to regional banks. Utilities are hitting 52-week high, outperforming banks, but rates are rising, right? You would think if rates are rising, you wouldn't want to be in utilities, you want to be in banks. So the equity market there is picking up the slowdown. You look at things like housing, you look at something like even industrials to consumer staples, right? Industrials have been underperforming consumer staples. That's another growth slowing signal. So I do think that the equity market is picking up on this growth slowdown, but I don't think the Fed is going to pivot as quickly as they did the last few times. I think that they have a credibility issue that they have to sort of rectify here. So I think that there's a huge delta going on between bond market pricing, Federal Reserve guidance, and equity market pricing. The divergences in the internals are suggesting that. And I think that that gap closes with a drawdown to risk and a rally in rates.
I've started getting bullish growth stocks because they're down, the ratio end is down 70%. And generally these inflection points is when everyone's shaking their fist at the screen saying, I don't understand why this shit's rallying. Can't you see inflation? That I'm just kind of thinking this is the time.
That's another good point. You notice since the Fed meeting the last, 2 weeks here or something, it's been Qs that have been outperforming again. And I think that is also, again, consistent with slowing growth, right?
When crypto the world as well, it's exactly the same thing.
I view crypto in very much the same lens as that, as sort of a risk-on asset that benefits from the falling real rates, right? So real rates are rising based on some of the feeling that the Fed's going to tighten soon, but I think that the equity market is starting to pick up on that growth slowdown and the eventual decline. The other thing is gold, right? Gold is not being receptive to a Fed that looks like it's right. If I told you that the Fed was going to hike 8 times, I don't think that gold is normally the place that you would pick first. So there's a huge disconnect that I see between rates market pricing and sort of all other assets. I think some of the assets are trying to front run. The Fed is going to pivot, so they're going to bid those assets up. But I think that we're going to be in here for a surprise, Raoul. I think that the Fed ultimately will pivot.
And do we see the internals change within that? So let's say the bulk of industrials and all of the kind of regular S&P stuff and the value stocks and the commodity stocks all come down in this and growth outperforms again? Or does growth come down further again? What are you thinking? You think there's another leg lower in this?
So I think that you have to split growth into 2 buckets, right? Whenever I say growth stocks, some people think Apple, Facebook, Google, because those are heavy in a lot of these growth indexes. And that's generally what performs well in the growth slowing environments, right? The big mega cap technologies. So I think those stocks do reassert their secular outperformance over the market. But also what's embedded in a lot of these growth stocks are the ARC type stocks. So I don't think those perform well. I think that those do fall under the weight of the economic cycle. So I think when you look at the basket of growth, you want to be, sort of the quality balance sheets, the big caps, low net debt, things like that. But some of your more speculative growth, I think, will continue to fall under the pressure of the cycle.
I'm assuming you're thinking the same as me. This rise in commodity prices is basically a massive monetary tightening.
That's exactly right. The commodities are doing the tightening of the Fed.
So I think kind of like how COVID-19 accelerated a lot of trends that were probably already going to be in place anyway, I think the recent military conflicts we're seeing are kind of accelerating some of the problems that were already mounting. And so, for example, we already saw Europe have some energy issues even before any of this conflict broke out, and some of that was now accelerated. I think same thing for food insecurity and things like that. And essentially, I think what we're seeing is a slow kind of unwind of the global monetary order that's been around for the past 50 years or so, and moving towards a more bifurcated world where we have maybe a little bit more decentralized payment channels, maybe more decentralized choices of storing value, as well as supply chains themselves becoming more bifurcated because we're seeing, food protectionism, commodity protectionism, commodity, different sort of trade happening around these more like alliances rather than in a global market.
What I'm trying to figure out is whether this is creating a step change in inflation, i.e. the trend of the last 30, 40 years is gone, or whether demographics, technology still kind of trump out in the end, and this is a temporary structural shift we're seeing, which is generating this.
So I think, most inflation is transitory, but transitory can last for years in inflation's case, right? So the 70s were transitory, but it was, it was long enough that, it wasn't really transitory in terms of a trading perspective, an investment perspective, a lifestyle perspective. And so my base case for a while has been that the 2020s would be more inflationary than the 2010s. The exact height that we were going to reach depends on these variables that are hard to predict ahead of time, like whether or not there'll be war. And so I think now we're at risk of hitting some of the higher levels. So I would characterize this kind of like the 70s or the 40s in the sense that we are going to probably have a pretty persistent amount of inflation. But even that, it won't be a straight line. If you looked at the 40s, you had price controls at some point. 70s, you had, price controls, you had wage controls. There are periods where even in an inflationary decade, you can have disinflationary periods, right? So you get these waves of inflation. And I think the 2020s will be no different, where you could get, for example, a de-escalation of some of the big trends we're seeing now. Things can be overdone, traders can pile in, things get too consensus, and then there's some sort of kind of unwind of that, and then you can have another spike up. We've already seen this happen in European natural gas, for example. There are periods where it got overdone, came back down, and then got even more overdone. And I think you could have the same thing on kind of a longer trend lines. Historically, money supply and CPI, if you use, say, 5-year rolling periods rather than the noisy kind of year-over-year period, there generally is pretty strong correlation, but there are periods where you can have a pretty significant disconnect, and that's usually due to some rapid technological change. We've unlocked some new abundance that allows for less inflation than you'd expect from the money supply growth. And so that happened, for example, in the late 1800s. You had the invention of the internal combustion engine, you had electrification, you had the discovery of oil. The United States had nearly unlimited land, and so that was abundance. And you kind of had a similar thing over the past 25 years where we unlocked so much global labor, and corporations were able to do a lot of geographic arbitrage, that you've had a disconnect between say money supply growth and wages domestically in many countries. And so I think that particular force is probably coming to an end, at least for a period of time, because I think we've kind of squeezed a lot of juice out of the globalization orange, and that now we might have hit kind of peak globalization, meaning that we don't unwind globalization necessarily, but we could stop accelerating globalization, and all else being equal, that should be more inflationary.
One of the things I'm thinking of is that the 1940s is probably the most similar period, less so the 70s. It's the post-war. It's kind of the same kind of structure we've got now. GDP was volatile. Inflation at first took off and then kind of eased over time once, we started to see manufacturing pick up and all of that. We saw yield curve control. We saw a lot of fiscal stimulus. What period do you think we're most similar to?
So I do think the 40s are the single most close period to what we have now. So what made the 40s different than the 70s is the 70s, it was very bank lending driven inflation, right? You had the demographics boom, the boomers were kind of entering the home buying years, and that was around the world. And so you had a big expansion of money supply led by commercial bank lending, whereas the 40s were totally the opposite, where banks weren't doing a lot of lending, and it was that monetization of very large fiscal deficits, the wartime finance, kind of a command and control economy. And also in the 70s, you had super low debt levels, at least public debt, and pretty low private debt levels. So they could raise rates dramatically to try to, cause a mild recession, kind of contain inflation without causing widespread insolvency. Whereas in the 40s, when you had sovereign debt levels very high due to the war, you couldn't realistically raise rates to double digits. And so instead, they held rates low. They did yield curve control. And so that decade, the 1940s, if you go from, say, the early 40s to the early 50s, when you had that kind of final inflation spike, you had about 6% average annual inflation, but it was very bumpy. You had literally, at one point, technically 19% year-over-year CPI, but then the next year you'd have like zero or even like mildly deflationary. Then you'd have another spike. And so I kind of characterize this period similar to the 40s. The one thing that might be similar to the 70s is the energy situation. So what made the 70s also unique, besides the demographics boom you had, is that U.S. domestic oil production peaked in 1970. So we had this kind of nearly a century-long continual expansion, more or less, of U.S. energy production. That peaked in 1970, and so the U.S. became more reliant on the Middle East at the same time as we were going through that very big demographics boom. Whereas now we have less of a demand shock, obviously, but we do have a supply shock. And so I think we have 40-style monetary and fiscal policy combined with, a not unlimited commodities, right? So that's where we get this more inflationary environment from. So I think the 40s are a similar environment, especially you could say, right now the United States looks like the 1940s UK, because back then the United States was running structural trade surplus. We looked more like China in some ways, right? We were the rising power, we were the export place, whereas the UK was more of the established power, the structural trade deficit, and going through the same sort of wartime financing.